Hi all, welcome to Diversified Finance. My name is Lakal, and today I'm not going to say much, which is a good thing, but rather I'm going to play this video and right at the start we're going to hear from Ken Henry, the chairman for NAB. For him, everything is perfect. The housing market has gone down only by 6%, but he says it's been going up for the past 6 years by 60-70%. So things are looking good. It's no issue for him. And then Carrington Clark, he interviews chief economist for AMP Capital, Shane Oliver, and the chief economist for NAB, Alan Oster. So for any bankers, right, anyone who works for the banks, for them everything's looking fine. Even though we have so many factors that could lead to a housing market downturn, and we're already seeing it happening right in front of our eyes. For them, everything's the blue sky. There's no problem at all. And one more thing I want to mention, the reasons for this housing market downturn, all these reasons, it's just not just it happened last month, right? It's been there for the past 3 to 5 years or so. So if someone was cared enough to go into details, right, he would have known that there's going to be an issue with the banking sector and the housing market, probably way ahead, probably in 2014 or 15, even in 16. That's where we heard about out of 1.7 trillion housing market, 500 billion loans are liar loans, right? So this is like a massive issue. So 30 to 40% of housing market, the home loans, the mortgages, 35% of that is liar loans, which is people cannot afford to pay them on time, they might not be able to pay it in the future. So if someone was because when housing market goes up, no one cares, right? You just, no point talking to them, or they'll say, oh yeah, you might see a bit of a hiccup, but it's gonna keep on going up. So but that's not the way the markets work, right? There are cycles. It goes up and then it corrects and it goes down, especially given that Australia had no recession and we always had a rising housing market for the last 25 to 30 years or so, right? So we never seen a 20% correction for the past 50 years, they say. So regardless, it's gonna come, it's here. Yeah, if someone asked me how about would you buy 5 properties in 2000 and would you sell it 2015? Of course I would do that, but right now it's not the time. There's time for us to get in, and there's a time for us to get out. So right now it's the time to get out. So that's all I'm going to say for this video. Maybe right at the end I'll just add something, and if I feel like I want to add something, I'll post the video and then just briefly talk about it. Okay, so please have a listen to this video.
Welcome to The Business. I'm Carrington Clark. Coming up on the program, a soft landing or hard time for house prices. We ask our experts how low property values will go. And a tale of two property markets, why office rents are soaring and vacancy rates tumbling in the biggest capitals. House prices are on the slide, but the debate's on over how deep the current downturn will be. The Sydney market is down 8% from last year's peak, while Melbourne has fallen around 5%. And the latest housing finance numbers suggest things are likely to get worse, with borrowers less willing or able to get loans. The chairman of the National Australia Bank and the former head of Federal Treasury, Ken Henry, says the Sydney and Melbourne markets are in a softening period, but won't have a hard landing.
In the 5 years before last year, went up by 73%. In the last 12 months have come back by 6%. So over the 6 years, house prices are still very well elevated. House prices have softened, but we don't foresee anything like a crash in house prices.
But Macquarie Bank has issued a dire forecast, saying the housing market is in the worst downturn in nearly 40 years. And joining me to discuss is Shane Oliver from AMP Capital and Alan Oster from the NAB. Shane, I might start with you. You called a similar, almost doomsday prediction, according to some of the housing market, a prediction of a peak to trough move in Sydney and Melbourne of 20% down. Now, this would be the worst housing fall in 40 years. Does the evidence that you've been seeing recently reinforce that view, or is it getting even worse?
It at least reinforces it, but at the back of my mind, I do worry that it's getting even worse. One of the indicators that I love to look at is...
So I hope you heard it. He said in the back of his mind, he thinks it might even get worse. So he's predicting a 20% correction. But he still says it might go further down. So it could be 30 or it could be 40. Who knows? It could be 50%.
There's auction clearance rates in Sydney and Melbourne on a Saturday night when they come out, and if anything, they've been deteriorating, notwithstanding last weekend was a Melbourne Cup holiday in Melbourne. But if you look at the underlying trend there, it's going down. We were sort of in the high 40% numbers. We seem to be heading into the low 40% numbers in terms of the clearance rate. That is consistent with the rate of decline in prices actually accelerating. And then when you put that together with housing finance figures for September, which came out today, which are again extremely weak, continuing to slide, ongoing anecdotes of tightening lending standards. Next year we're going to have comprehensive credit reporting, which will make it easier for the banks to check on who's got multiple loans and they're not telling us about. All these sorts of things, I think, are actually putting more and more downwards pressure on prices. So yes, my base case is a 20% top to bottom fall, but I'd have to say the risks, if anything, are tilting a little bit to something a bit worse than that.
Is there not anything in the most recent data that Shane's referred to, Alan, that's giving you pause for thought on this issue? It does appear that things aren't plateauing. They seem to be getting worse and worse, and those auction clearance rates would suggest there's still a lot of downward price pressure to come. Aren't you starting to get a little bit more concerned?
Short answer is not, no. I think if you look at the actual, and CoreLogic put out essentially weekly house price data, but if you look at, say, their monthly data and you look at what's been happening in the annualised growth rates, the way I look at it, look at the last 6 months, annualise the growth rate. In Sydney a couple of months ago it was -10, today it's -5. So I'm sort of in the, when I actually look at what you sold your price for, it doesn't seem to me that it's continuing to collapse. It seems to be, if anything, bottoming me out a bit. And I go back to fundamentals and I say three things matter: supply, demand, interest rates, and do you have a job? And the level...
Yeah, so as you heard, he mentioned supply and demand, right? But when you say supply and demand, there's so many factors, like, that we can go through, especially when we focus on demand, right? Demand, like, because of tighter lending, demand is very less at the moment, like, and the borrowing capacity is reduced by 40%, right? So that means they are kind of killing the demand, and at the same time we are still building apartments, right? So meaning we still add 200,000 or so apartments per year. So it's obvious, right? Demand, there's decrease in demand, increase in supply. So what does he say? Like, the housing market is going to go down. So according to this guy, like, I'm not going to disagree with him. Like, he could be right or I could be wrong. But what I'm trying to say is, it has to start somewhere, right? Like, housing market has been going up for so long, for 6 years or so. It has to. We're gonna be like a trend reversal, so we are right at the top. So looking at last 12 months, we might not see much, right? So, but it doesn't mean, like, it's gonna get stagnant and gonna go back up, like, and start going back up to a medium house price gonna go back up to like 2 million. No, so that's not a fair comment to say. But we are clearly seeing right now a trend reversal, and which is pointing towards down. So the best case is right now, but he just completely denied, and he said no, he's not seeing any problem. But that's not right. Like, it doesn't make sense. Like, I mean, I'm not trying to say, like, yeah, I mean, I'm totally right, like he's totally wrong. That's not my point. But if we sit down and think about it, right, we somewhere in the lines in if you look at the trend, like, it has to, when the market goes down, we'll see a trend reversal. So we are right at the top, but if we wait for another 3-4 quarters, right? If we wait till mid 2019, I think it'll be very clear it'll be very obvious. It'll be obvious, and we don't have to argue about this housing market gonna go up or down. But the problem is, when we get to June 2019, it'll be too late. So if an investor want to make money out of any asset class, right, the main thing is you need to know when to get in. Like, if you see like a bull run, you get in, and if you see like, the market gonna kind of like gonna get stagnant, or if you see like, it's gonna if you feel like we're gonna see a trend reversal, that's when you sell and you get out with a profit, right? Like, if you wait till to end of 2019, all the money that you made for the past 5-6 years would be gone, right? So as you heard from Ken Henry, he said for the past 6 years we are up 70%. But if the market goes down by 50% from now, or maybe say, let's be realistic, say if the market goes down by another 30% from now, right? So you're looking at 40%. You're looking at say 40% less money that an investor can make out of the housing market, just because he did not get out at the right time. So I'm not disagreeing, but I'm just trying to put it's my opinion, and this is not financial advice anyways, but I'm just trying to say what he says does not make sense to me. But let's see what he got to say.
Of unemployment that causes a lot of grief is basically around 8%. So to me, what you've got is a postcode issue. Now, a general slowdown, fine. Not helping the economy, yes, but you need to put it in a bit of context.
Shane, Oliver, the numbers today would suggest this is spreading. Previously, it seemed to be mainly confined to the investor market, but the numbers today suggest owner-occupiers also down over 11%. That's in addition to investor lending down 18%. How bad do you think this will get, and when do you feel like this cycle will end?
I think it will continue until 2020. I think we've got another 2 years of pain in the housing markets in Sydney and Melbourne. Now, of course, if everything came down faster all at once, then it would probably end quicker. But at the moment, I can't see what's going to bring it to an end. Don't forget, on the way up, we had this thing called FOMO. First-home buyers got in, investors got in for fear of missing out. Investors were saying, well, last year it did 10%, the year before that was 8%, let's project those numbers off into the future. Now, of course, as prices come down for first-home buyers, it's not such a big issue, but if you're an investor, you're getting a net rental yield there of maybe 1 or 2%. You really need decent capital growth to stay in that property, to make the investment stack up. But if you're seeing prices come down and that goes on for too long, then you start thinking, well, gee whiz, maybe I should be getting out of here. And FOMO, fear of missing out, becomes FONGO, fear of not getting out. That's the big worry here, that it starts to build on itself on the way down. Now, I'm with Alan in the sense that I'm not forecasting a crash here. 20% sounds bad, but it just takes us back to where we were in the first part of 2015. So I'm not talking about a full-on crash here, because I don't see a massive rise in interest rates and I don't see a huge rise in unemployment. But I do think we've got a lot further to go from here. The other aspect, of course, is there is a chance of a change of government. Some would say a very good chance. Change there would bring less access to negative gearing and a reduced capital gains tax discount. Now, investors who at one point were 40-odd% of the market, still fairly significant players in the market, if you're thinking of investing today, you've also got to think about who you might sell to 5-10 years down the track. Now, your pool of buyers won't be there like it was a few years ago.
Alan, also, you make the case that the economic fundamentals are pretty strong, but doesn't that make it even more worrying that we've actually seen house prices fall as much as they have and continue to fall? Doesn't that suggest that there was a lot of speculation in this market? People were buying in, thinking that prices would continue to go up. And as Shane Oliver points out, now that that is not the case, won't we see a lot of people potentially selling their houses off to get out before it gets even worse?
So I'm not trying to downplay things here. I'm just saying you need some perspective, need to understand what's happening. If you tell me that for whatever reason, be it China or Trump or something, we manage to get our unemployment rate up to about 8%, I'll tell you we'll have a double banger recession, because that will then trigger the problem. And you look at the big banks and you see, say 60 postcodes we don't like, which is 1% of all postcodes in Australia. It's explaining in the NAB book nearly, or the best part of 40 to 50% of all our bad debts. So it's highly specific to certain postcodes. As we go forward, what are we seeing? We don't see in any of the big banks' reports, and they've just come out, a significant increase in defaults in the housing book. Maybe it's too early, but we're not seeing it. And so I think, again, not great for consumption. And I think it will slow the economy, because we see the consumer as really weak, and particularly in areas like discretionary retail, where they have the option of buying or not buying. And that slows the economy. But there are other things, as I said before, that are sort of powering it along for a while. So I think you need to be a bit balanced. It's easy to get a headline by saying, house prices are crashing, etc., etc. I think from a perspective of, how is this affecting the economy, it's not helping, but I don't think it's hurting a lot either.
The debate goes on. Shane Oliver, thank you for joining the business. Alan Oster, thank you as well.
Thank you.
Okay, that's it. That's all I want. That's the video I was planning to play. So I'm not gonna, I'm gonna stop right here actually. Yeah, so it's totally up to you guys to decide, for those who got into the housing market in 2017, if they can hold their property for another 10 years, 5 to 10 years, I think they'll be fine. But the issue is, he mentioned, Shane Oliver mentioned, interest rates are not going to go up. That's probably up. I think he referred to RBA, Reserve Bank of Australia, but international rates are definitely going up. They already, in Federal Reserve, they already mentioned, in December they're going to increase interest rates again by 25 basis points. So their cash rate is sitting on 2.25 at the moment. So by December it will be 2.5, and then they said there'll be another 3 to 4 interest rates hikes in 2019. So you're looking at 2.5, yeah, about 3.5 Federal Reserve cash rate by end of 2019. So what would happen to the Australian dollar if Australian US dollar keeps on going up, because they keep on increasing interest rates? So sooner or later RBA will have to increase interest rates, and regardless what RBA does, banks, 30% of banks' funding cost is tied to overseas borrowings. So if overseas interest rates going to go up, they will, regardless of what RBA does, they will definitely increase the interest rates. So it's inevitable, and we cannot also forget 360 billion interest only loans going to expire starting from 2019 to 2021, right? So supply going to increase, demand, they're killing the demand, so demand is decreasing at the same time. So there's one conclusion that we can get to, the price has to go down. It'll keep on going down until it matches the realistic values for these prices, especially in Melbourne and Sydney. That's where we've seen the biggest growth, and when the market goes down, that's where you see the biggest decrease in house prices. Yeah, so that's all for today. I appreciate your time. I'll talk to you in the next video. See ya.